Highest ever level of individual loan disbursements in history. Previous highest had been March of 2022. So the growth momentum continues to be strong. You will always see 1 month, 2 months here and there where the growth may be little more, little less. But generally speaking, the growth momentum is still very strong.
How will the lending rates harmonize between HDFC Limited and the bank on certain products
So
like loan against property, etc.?
So as it happens, every customer who moves into the bank will move at the existing interest rate. So theoretically, if your interest rate today, for argument's sake, is 8.5%, then when you move to the bank also, your interest rate will be 8.5%. Now, the benchmark may move from HDFC RPLR, as we call it today, to a repo link product. We see all banks today have both repo link loan products as well as they have their traditional uh, own cost-based products. So initially, customers will move to a cost-based product, but they will have the option to move to a repo rate product.
What has been the impact of higher rates on customer preference? Have they postponed their purchase or demand per se, or are you witnessing the momentum to continue despite the rates that have increased?
So the way I would look at it is that a housing loan is very different from a short-term. Typically, a housing loan stretches for about 13 to 15 years. Now, in a period of 13 to 15 years, when you take a floating rate loan, interest rates will go up and interest rates will go down. Interest rates are never fixed. Now, today, if rates are high, then at some point of time, rates will come down. Already there is talk of global rates coming down by the end of the year. So at some point of time, you may see rates in India also come down. So if you've taken a floating rate today at a higher rate, your rate will come down. If today, for example, the rate was low, the rate can go up. So it really doesn't make too much of an economic impact whether rates are high at the point of time when you take a loan or not. Sentimentally, it does make a little difference, but it's not that significant. For a shorter term loan product, my sense is the impact might be more.
Can we expect softening of rates by RBI this year? If so, by how much could the rates from RBI get softened by?
Again, very difficult to answer that question off the cuff. But if the rate increase, to my mind, reached the peak of the rate increase. Now, data will have to be watched. I'm sure RBI will be very carefully monitoring, watching every bit of data that comes out of the system, inflation numbers, monsoons, and there are so many other oil prices, geopolitical issues. So there are so many factors RBI would consider. I don't know whether it's in the next 3 months or 6 months that they will start reducing rates. Economic growth continues to remain strong. So my sense is rates, so some degree of rate stability could happen for a while, and then at some point of time, RBI could start looking at reducing rates. But to put a number to it or to put a month to it is virtually impossible.
How do you see the impact on housing finance sector from the interest rates, or what can this spell for your net interest margin and steady state of net interest margin? What could be your endeavor over there?
See, historically, we have always targeted a net interest margin which is between 3.3 and 3.5%. Every quarterly numbers that we've been giving you over the last several quarters, net interest margin range has been 3.2 to 3.5. This year, the net interest margin was 10 basis points higher than last year and stood at 3.6%. The last quarter, the net interest margin was even 3.7%.
Well, with the expected integration, how do you see the housing finance segment growing in FY24?
In my opinion, the growth opportunities for housing in the bank, in HDFC Bank are enormous. Today, the bank does not distribute housing loans from all their locations. But post the merger, it's certainly something that they would be able to do. Secondly, if you look at the customer penetration, only 2% roughly of their customers have taken housing loans from HDFC. Another 5 odd percent have taken loans from other banks. So look at the ability to cross-sell to the 93% who have not taken a loan at all, and to the 5% who have taken loans from other banks. So it's according to me, a huge opportunity for the bank to grow.
What kind of cost may get rationalized over a period of time once the benefit of the integration starts to kick in for the merged entity?
See, realistically, HDFC's cost structure is extremely low. We have probably the lowest cost income ratio in the financial system in Asia and one of the lowest in the whole world for a retail financial institution. So obviously, when you marry the two institutions, the bank has a higher cost income ratio, HDFC has a lower cost income ratio. When the balance sheets and the P&L accounts get merged, logically the cost income ratio should come down. Having said that, the bank is expanding, they're setting up more branches, which may incur some amount of cost. So the immediate benefit of a sharp drop in the cost income ratio may take a little while for you to see. But that's something the bank would be fully cognizant of because they're setting up so many retail branches where you incur upfront costs, but the benefit of those branches only come over a period of time as you raise more deposits, as you get more business through those locations.
Well, sir, the only point in your result was the massive decline in non-individual portfolio, almost by 11.5% on a YY basis and about 4% on a sequential basis. So what is happening over there? Why has the portfolio declined? And would you be comfortable if that book continues to run down?
Look, there are two parts to it. Part of this we had discussed even in the last earnings call. If you look at the non-individual book, we have three categories of loans. We have construction finance, which is currently about 7% of our total loans. We have lease rental discounting, and we have corporate loans. So these are the three segments of loans that we carry in the non-individual category. Our total non-individual loan today stands at 17% of the book. 7 is construction finance, 6, if I recall right, is lease rental discounting, and 4 is corporate loans. Now, construction finance loans, as we've been saying time and again over the last 2 or 3 quarters, the pipeline is healthy because the construction activity has started picking up. You've seen the huge demand for residential properties in recent times, and you see this reflected in the results of most of the property developers in recent times. So the demand is very strong. And as the demand, to satisfy that increased demand, more and more developers are looking at launching more and more and bigger and larger projects. Now, whilst we may approve loans for those projects, the disbursements for those loans will only come over a period of time. Whereas in a lease rental discounting loan, the disbursement is made upfront. So construction finance pipeline is healthy. Growth will come, but will come over the next 2, 3, 4 quarters. So that's one reason why the non-individual book growth has not been strong, because today what we would otherwise be dispersing is loans which would have got approved, let's say 2 or 3 years ago, when the demand for housing was not so strong, and therefore not too many projects were being launched. The second element is the fact that in our books, we have certain loans which don't comply with the RBI requirement or the bank's lending rules. So as these liabilities mature, as these assets mature, we've taken back the repayment of those loans and we've not given fresh money. So consequently, and most of the non-compliant funding from the RBI or the bank perspective is broadly now completed. So I don't think we will see too much more of repayment of existing loans which are not compliant with the bank. So you would at some point of time, to my mind, and not too distant future, in a quarter or two, start seeing the non-individual segment beginning to.
Okay, that's interesting. So retail housing segment has moderated. The growth has moderated a tad bit, but still very strong in terms of net interest margins, a 7-quarter high over there. And a lot of talk about the way forward as well. Siddharth Khemka is still with us. Siddharth, apologies, we had to interrupt you there because we sort of were awaiting the management commentary from HDFC. But you heard what Keki Mistry had to say. How are you feeling about this space in general and this stock?
Yeah, so I think the